Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. It is not intended, nor should it be considered an invitation or inducement to buy or sell any of the underlying instruments cited, including but not limited to crypto assets, financial instruments, or any instruments that reference any index provided by CF Benchmarks Limited. This recording is not intended to persuade or incite you to buy or sell a security or securities noted within. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making any investment decision. Some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.
Europe is often overlooked, and I had a good example at a conference in the Middle East last week and met lots of people there. And the question is, what do you do? And it's like, well, I work for an ETF in Europe. And I said, we didn't know you had crypto ETFs in Europe. And I think it is sometimes kind of missed on the radar. And just for listeners, the ETFs or ETPs, as we call them in Europe, and we could talk about sort of structure and naming later. But they were the first region to launch. The first were here in Europe, in Switzerland and in Germany. And we as ETC Group were one of the very first listed products. And the first one to do so via being regulated in Germany. So the market here is quite far evolved compared to the rest of the world. So we can do more than just Bitcoin and Ethereum. And I think as of sort of last week, total assets just for a scale were around about $15 billion across all products. And certainly, the regulatory landscape and continental Europe specifically, and in terms of institutional client demand and usage, is quite far ahead of the rest of the world. And sometimes we feel a little bit overlooked and ignored.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, I'm Ken O'Deleger, and I'm joined as usual by my colleague, Gabe Selby, who's head of research. Hi, Gabe.
Hey Ken, great to be here. Really excited to have our guest today.
Today we're super fortunate to be joined by Chanchal Samadder, who is head of product at ETC Group, one of Europe's leading digital asset-focused investment management firms. Now, we're not halfway through the year yet, but it's already been obviously a seismic one for crypto ETPs with that inflection point in January. But what some of you may not realize is that exchange-traded crypto products have existed in Europe for half a decade, or probably a bit more. It turns out ETC Group listed the world's first centrally cleared Bitcoin exchange-traded product in June 2020. Now, why we have our special guest with us here today is because they've actually listed another one. So, Chan, we are really, really pleased that you've taken time out for your busy schedule to join us.
Hi, Ken. Hi, Gabe. No, I'm delighted to be here. I'm very excited to have this conversation with you guys.
Yeah, indeed. And fast forward to now, and ETC has launched another Bitcoin ETP, ETC Group Core Bitcoin, ticker BTC1. Now, obviously, we're going to talk about that extensively, and we also hope to get a flavor of the European institutional digital asset market as well from the expert we have in our midst. So, Chan, to begin with, I think probably the most logical place to start is you had one Bitcoin ETP already in existence. Why did you launch another one? And if there's a difference, what is that difference?
Yeah, thanks, Ken. Not another Bitcoin ETP, right? Yes, we already have an existing product. As you mentioned, it was the first centrally cleared product we launched back in 2020. We were the first global Bitcoin spot products in the market. So why have we launched another one? Well, the market has evolved significantly since we started as a business and we listed that product. So when the genesis of that product came about from the co-founders, my boss Tim and Bradley here, the market structure was very different. And all we were aiming for is to really have a vehicle which made Bitcoin as an underlying simple, safe, and accessible, mainly for retail investors. So it was really an access point because it is still, very complex and scary for many investors to go and set up direct accounts with, digital native exchanges, go through and trade in a whole new infrastructure that they're not familiar with. Most investors are, very familiar with their traditional brokerage accounts. And the idea was very simple, to make it really safe, easy, and accessible for them. And fortunately for us, the product has been and continues to be a roaring success. We have over $1.5 billion in AUM, and it's still the most used product in Europe in terms of AUMA, but also liquidity and trading volume. So it is still the leading product. So why did we launch another one? Well, the main reason is the world and market has evolved quite significantly in the last 3 to 4 years, and we've heard about the institutions are coming, and it's become maybe a bit of a tiring phrase we keep hearing. But we think the launch of the US spot ETFs certainly is a catalyst, and was a catalyst for that. Obviously, the nature of the types of investment firms that issued those products has brought a real legitimacy to Bitcoin and crypto as an asset class. And what we've seen here in Europe is that has woken up investors to this asset class once again, because I think it has to be taken seriously. If you look at it from any perspective, fundamental, liquidity, traditional portfolio theory, it is and does play an important part in investor portfolios. And as I said, our old product BTC, is very much serves a purpose as a trading vehicle. It is highly efficient for investors, who want to sort of get in and out very quickly because of that very natural liquidity. But institutions have different needs, and one of those is generally they are more sort of long-term and benchmark-focused investors. They're not typically trading, particularly here in Europe, where I think the difference maybe between the US and Asia in terms of the average behavior of European ETF and ETP buyers is that they're generally more long-term, more buy and hold, and they generally see the products more through the F lens, the fund or product lens, rather than the ET lens, which is the exchange.
Right. Yeah. Yeah.
So typically, with institutions here in Europe, these ETFs are going into fund of funds, and that lens is funds. And so they want to see valued like a fund. They want to have a benchmark like a fund. They want a time in point valuation. So from our perspective, we thought we don't want to touch a product that's very successful, and investors are very, very happy with using in a certain way. But also we want to be able to empower and enable investors, to make choices. And this one, the new BTC1 product, which we've obviously launched with very special benchmarks, with CF benchmarks, is very much tailored and designed for that institutional investor base, where, as I said, other factors are more important. But ultimately, we have two products, and we envisage many investors actually using them both for different parts of the portfolio.
Sure. Now, you touched on this a little bit. One of the most, or probably the most exciting aspect of BTC1 is what you guys have called the Tri-NAV, which is where CF Benchmarks comes in. Because whilst the official, if you like, official inverted commas, net asset value calculation index will be, of course, a CME/CF Bitcoin reference rate, our flagship regulated benchmark. It's been existing since late 2016, the CME Group settlement benchmark. Also, obviously, the reference price and benchmark for billions of dollars worth of listed products around the world. You've also become the first firm to, I believe, offer 3 NAVs, including BRR, but also including BRR AP, Asia Pacific, a variant of BRR, and also BRR NY, which is obviously the New York closing time version of BRR. Could you give us a bit of a color on that? Why you chose that? What was it about this system that particularly impressed you? And how you see this playing out going forward?
Yeah, absolutely. Yeah, it's a really exciting element of the product, and we believe it's something truly innovative, and not innovative for the purposes of just being innovative, but actually has utility, and we think serves a purpose for clients. Yeah. So first and foremost, why BRR, which is going to be the primary benchmark, I think for us, that was really a no-brainer in terms of institutional quality benchmark, in terms of the CME futures being that assessment price. And we very easily came to the conclusion that the benchmark is going to be CF benchmarks BRR as the core primary benchmark, because it has everything, and from my background in ETFs and most of my career has been basically analyzing, selecting and co-designing indices, going through the methodology with the team at CF, and reading all documentation. I can say by far and ahead, the best reference point for Bitcoin. So the second question is, why does Bitcoin need a reference point? And why do we even need a benchmark for anything? Well, that's very important and interesting, because Bitcoin and the nature of the cryptocurrency generally, or all cryptocurrencies, is they trade 24/7. So there is no reference point really. And not only do they trade 24/7, they trade in multiple jurisdictions, in multiple pairs. Even within dollar, you've got fiat dollars, USDC, USDT. So there's a huge deal of fragmentation, even though Bitcoin is one of the most traded securities when you put it all together. But what is the right price? What is the right point in pricing? And how do you ascertain that? As an institution or as any investor, how do you know that is the fair price and right price? And that's where we think the methodology of BRR really stands apart. And obviously that has attracted other institutional liquidity to that reference price, and liquidity begets liquidity. And we really think, BRR is kind of the standard for Bitcoin. So that's point number one. And then, well, why then BRRAP and BRRM wipes? And again, quite a few factors went into it, but ETFs, I think a lot of people don't realize, they really have played a critical part in just global market infrastructure. Not prominently, but in terms of bringing liquidity and porting liquidity globally, they've been one of the most important innovations and tools that all kinds of investors use. And two cases in point is, first and foremost, a benchmark like, global emerging markets, that's across, 15, 16 time zones, 22 currencies, 22 countries as well, I think, and 1,200 securities. And that, an investor sitting in the US can, make one click and access, that liquidity or that opportunity set, let's say, when a lot of the underlying is closed. And it's really created liquidity on many underlyings. The other example is fixed income, where it's a market that was specifically in credit, very unfractionalized. The round lots were very high. And again, the ETF wrapper bought liquidity. I would say this is the first time where the ETF is playing catch up, because markets have taken the world one step further with 24/7 access and liquidity. And maybe in a digital age, that's where all markets should be. But certainly, this is the first time me working as an ETP builder that I feel like, oh, wow, the underlying is almost better than the wrapper. So it's how can we now bring the wrapper closer to what is Bitcoin, really? How can we provide the maximum access to Bitcoin pricing and liquidity? So that was the thinking around, right? Can we get more of Bitcoin, into our traditional wrapper? And that's what kind of the genesis of the thinking internally of, okay, well, why don't we look at the other benchmarks? Well, why can we not use all three? And it had never been done before. So it required a lot of checking in terms of regulatory compliance perspective. Is this actually physically implementable? And we figured out finally that it was. And so what it means just really for an investor is, obviously they can trade the product on the secondary market on a regulated exchange like Xetra under normal market hours, but that's only 8 hours a day for any product in any region. But with this additional of the two NAVs at either end of the trading day, if you're based in Europe, means as an institutional investor, you not only get a wider liquidity window, but you also get a deeper liquidity window. So in terms of primary liquidity, you are now able to access far greater amount of the underlying crypto, again, at a regulated, well-constructed benchmark price. So we're really excited, and sometimes innovation for the sake of it, or for the sake of
no, absolutely. This is obviously prima facie, axiomatically, a major step forward. But Chan, just to be absolutely clear for listeners and viewers, is this Tri-NAV facility create and redeem at all three of these reference prices, or is it just redeem at BRRNY and BRIAP and create and redeem at the official NAV?
No, it's create redeem at all three. So you can
That's
create
amazing.
and redeem at BRRNY, create and redeem at BRR,
Wow.
and create and redeem at BRIAP.
That's amazing.
Yeah. And again, we think also just, because again, the nature of crypto and Bitcoin and the volatility, it is something we think is important for quite a wide subset of institutional investors, that it's such a volatile and event-driven market that, we think for many investors, there may be a need that they may need to exit. Probably the exit is more important. The ability to get out is more important.
Yeah.
But there's something happens after European close. There's an event in Asian trading hours. Those investors now have the opportunity to risk manage their positions and therefore their overall portfolios, and actually be able to exit or increase their position based on news flow. And again, an asset class most investors are not familiar, or quite uncomfortable with these levels of volatility. And relatively, obviously, Bitcoin's intra crypto. Bitcoin's more mature and less volatile.
I get the impression that it's almost like the facilities there. It may not necessarily be used, but there's obviously, we can conceive times when it would be really great to have that out as well. 2 times extra a day. So yeah.
Yeah, absolutely. And then there's another subset of clients who are not as big, let's say, but there are many investors who are global in nature, many hedge funds who are global in nature, who we do think will actually use this facility more frequently. And similarly for those clients, and there are quite a numberable, let's say, a decent minority where they are able to, from their perspective, trade the US products and the European products and the Asian products. What with our Tri-NAV means is you can actually hook in to the Asian and US products. So very simply, what an investor can do is use an Asian product in the morning in Europe, and then if they want to continue trading, they can, because they reference the same NAV, they can do a NAV to NAV, known as a NAV to NAV switch in ETF speak, basically across to the European product, our product, and if they so wished and wanted to continue sort of utilizing they could, which again on NAV to NAV on BRNY into a US product tracking one of your benchmark there. So again, that kind of fungibility, synthetic fungibility, we think would be quite interesting for quite a few investors.
I think this is a pretty timely conversation that we're having. I mean, essentially, we've seen in the news, most of the audience, and maybe you all are aware of all this talk about having 24/7 trading, even the TradFi world, right? So there's been talks of exchanges, broadening their windows of operation to 24/7, just like you see in the cryptocurrency space. And so I really liked what Chan said, where he was saying, he reminded us, the institutions are coming. Well, just to kind of add to that, I think you can say now, like, the institutions are innovating. So just like we appreciate the technological advancements of cryptocurrencies and blockchains, we're now seeing that kind of spill over, I think, into the institutional side, such as with the ETC group and their new Tri-NAV, this novel Tri-NAV approach, and kind of innovating on that front. So I just think that's a really timely thing to be talking about and really interesting. But I think, just Jen, just so to rehash, I guess, on the purpose and the need for going into this BR world, which is our world, and we've seen how this liquidity begets liquidity. Are you saying that the primary reason was to kind of create this more institutionally focused type product?
Yeah, absolutely. And obviously, we're not precluding retail from using it, and we'd love them to use it. But yeah, it was very much designed with institutions front and center of mind, and in terms of really addressing the needs we think they have. And I hope I have a little bit of an idea, just having a background in sort of building ETFs. Generally, in Europe, the market is quite institutionally focused. I think, again, maybe some of your listeners across the world, one thing to point out is the ETF market here in Europe. So that's all ETFs. Is still about 80%, we would say, institutional. So basically non-retail, so intermediary asset managers, wealth managers, and asset owners. So they are the main and biggest user of ETFs here in Europe. And we envisage it is already looking like and will be the same for crypto ETPs as well.
Well, that's an interesting point. And maybe we can stick on to the topic of composition and landscape. We've noticed some trends in digital asset allocations, and I would assume, but I would like to get your take, that in Europe, is the demand for these types of tokens, is it primarily driven towards the bellwether tokens like Bitcoin and Ether, where we see like 90%, over 90% of the demand here on the institutional side is really just focused really on those two tokens right now? Does that composition make sense also in Europe, or is that what you're seeing?
Yeah, I think it's a little bit further ahead than that. In terms of obviously market size and just addressable investor base, Europe is smaller than the US. But in terms of breakdown of that market, I think today it's about probably 70 to 80% Bitcoin and ETH. But obviously we have a lot more roadway and rope and flexibility for product design here in Europe. So the really important thing is that, in terms of listing rules and regulation, we can, launch and other products, like Solana, like other chains as well. And there is really a good proliferation of single underlying token products here in Europe. But we think that's, if you look again at where the assets are, there is for sure some demand and use for those. But I think the main innovation is, and the third biggest bucket is a diversified index product. And really that's the future, we think, of the market long term. We think actually Bitcoin and Ethereum will probably stand out as individual allocations, but most investors will probably, as a first step, just use a broad index exposure. And that makes perfect sense, especially in an asset class like this, where there is a lot of risk, there's a lot of volatility. Even projects in the top 20 today, you really don't know if they're going to be here tomorrow. And if you look at the top 20, even the top 10 from 5 years ago, on any kind of crypto screening platform, it's very different, and that evolves. So an index product really captures that evolution. And for investors who's going to come to this very new and have no view, it's probably the most simple first step to make before building internal capabilities and research teams to make the decision to, okay, actually we want more Bitcoin or we want more Ethereum. So the market here is further ahead, but from our perspective, we don't see it going further than Bitcoin, Ethereum, broad diversified. And maybe I think we're just seeing Solana mature as a layer one platform, with increasing use cases and developers. So that one, I think is on the borderline of potentially being, let's say, institutional eligible. But beyond that, there are some investors in Europe who will do other things. But if you're looking at the core cohort, that's where it's at. And then sort of taking one step back and just looking at generally investors, it's very, very diverse here in Europe. There are a small but growing cohorts of investors who are highly sophisticated in this space, and who really have real capabilities, and to the point where they are looking at building their own infrastructure in terms of crypto wallets and then allocating themselves. But they're very few. That you could probably count them in two hands here in Europe. And then the rest of it is a big middle ground of investors who have not yet allocated and really trying to still understand and figure out the space.
Yeah, no, that makes sense. And I would certainly agree with what you were saying in terms of the European region, or you all over there being much more further down the path than us over in the States.
In some ways, yeah.
Well, and with that regard, you all recently launched an Ether ETP, and of course here in the United States, we're holding our breath, waiting for a spot ETF approval by the SEC. So also, in that regard, you're also I guess ahead of us. But I wanted to ask you: is there any potential for staking, or are you all staking in Europe?
Yeah, we are. So, and not just us, some our peers as well. So, yep, staking is allowed and kind of done here in Europe. I guess just to sort of point out the unique sort of element of that product is we're the first ones who have decided to open ourselves up and track a total return benchmark. So it means from an investor perspective, they can actually properly judge their performance because most of the other products historically have just sort of tracked the price return. And the nature of ETH rewards are quite opaque and not consistent. Let's say you have 3 types of layers of rewards there, and they're not traded consistently. So we're the first ones to track a total return benchmark on that product. But again, it's institutionally driven, and most institutions want a proper benchmark. And for an ETH total return product, it makes sense to have a total return benchmark.
Yeah, we do actually have, as you probably are aware, an ETH staking reward rate, which is obviously akin to the same standards or as our other benchmarks. Well, I'll let the sales guys get on to you about that, Chan. Now, Chan, I wanted to direct the conversation a little bit more towards Europe, as we really have done. There's some amazing insights here. I think, obviously, the key differentiator between the US, say, and Europe is what we have here in the EU called their UCITS. It's an acronym, UCITS. Just to get it right, it's like an EU directive for ETF standards. And it stands for Undertakings for Collective Instruments in Transferable Securities. Essentially, it sets some standards for what can be an ETF or what can't be an ETF. Now, becoming UCITS compliant is something of a holy grail for digital assets, crypto ETPs. But is it something you'd consider pursuing? And if so, how would you get that done?
Yeah, it's a great question. It's a great question because it's, again, one common feedback from when I speak to people outside of the EU is, well, they're not ETFs, but they are. In terms of, we can't call them ETFs, but
exactly,
from a structure, risk, and investor protection perspective, that they are identical. And it's very similar to the products in the US, why they're not 40 Act funds and they have to launch under 33 Act. And it is just a regulatory framework we have to follow as an issuer. So there's 2 legs to this, I suppose. So one is crypto as an asset class. And that is not eligible under UCITS. None of the regulators will see that as a proper asset class like equity and fixed income. So today, you can't have any kind of ETF or mutual fund holding crypto and calling itself a fund because of the asset class. The second is diversification rules. So under UCITS, because it's for funds and diversified funds, and not just ETFs, but mutual funds as well, there are certain criteria around diversification you have to meet to be eligible to call yourself an ETF or a fund. So obviously under that, the single assets will never be UCITS fund ETFs. But we hope one day the regulators in Europe, will see crypto as a regulated and legitimate asset class, which means, for the diversified products at least, we can, properly wrap them and structure them as funds. But again, to reiterate, the way we and all of our peers here in Europe, have structured our products is with, the utmost integrity, safety, and investor protections in mind. And they are all physically backed by the crypto, held in cold storage. They are all regulated, MiFID regulated securities. But it's unfortunate that we, from a labeling perspective, and we don't want to fall foul, obviously, of a regulator, that the single assets will always be ETPs. And that's exactly kind of looking at it through a more traditional asset lens, the gold products here in Europe. Again, in the US, they are 33 Act funds, but in Europe, they are ETPs under the ESMA regulations. But what has helped with those gold products is, most investors are familiar with that structure and comfortable with that structure. So that is a strong positive.
Chen, no, it's been great having you on the show. And one thing that I always like to ask our guests who are working on interesting stuff, such as yourself, what are some of these? Are there any high-level plans that you guys can share with the audience and for us right now? I mean, I don't want to sound selfish, but I'm really interested to find out if you have anything that you can share that's coming around the corner.
I can give you sort of a high-level idea for sure. Look, I think for us as an issuer, we have some very strong ethos that, anything we wrap, the underlying crypto has to be, first of all, we have to believe that it is a sensible, robust, stable project, is not a, we don't want to ever luckily we didn't have a Luna product or something like that, where the underlying really does, ultimately it does wrong by investors, let's say. And so from our perspective, we want to be very considered around products, and really launch projects which we think has a utility use case, and then the product wrapper has to be institutional grade, and we want to have the best product. And I think it's probably the same for all of us issuers, but I think our obsession is whatever we deliver, we want to make it the best, and that could be from many elements. So with obviously the BTC1 product we've done with the years, we think it's now, we hope, has set the standard, not just here in Europe, but globally, in terms of Bitcoin products, because we've considered things that we think are going to be very important for investors, and actually deliver that to them. So without giving too much away, that's going to be focused straightforward. So you're not going to see what there's a saying in ETF world called the throwing the spaghetti at the wall strategy, right? Where you just launch products and just hope something sticks, and typically something does. But no, very much from our perspective, we feel a real responsibility as an issuer, that to be sort of guardians to our investors, and only bring what we legitimately think is actually a proper project, or a proper well-constructed index in some cases to investors that has all of the kind of safeguards in place for them, so that it gives them the comfort and security of knowing that it does what it says on the tin ultimately.
Sure. We look forward to being sort of fellow travelers with you on your continuing journey. And so congratulations with the launch. And Chan, we got to have you back on in, I don't know, 6 months or whenever you're available, to tell us how it's going and developments, what you're seeing in terms of the investor register for BTC1.
Yeah, a few exciting things already. We've obviously just launched, but we've had a few very exciting conversations. So hopefully we come back in a few months and really talk about some exciting developments.
Brilliant. Thanks for joining us. We really appreciate it.
Yeah, Ken, Gabe, great to be here. Thanks for having me.
Wonderful.
Thanks, Chan.
Cheers.
So that was Chanchal Samadder from ETC Group. And I'm sure you'd all agree that was highly informative about the European digital asset scene, particularly the institutional side. And we really appreciate him coming on board. If you enjoyed that, do go on Spotify or any of your favorite platforms to find our other episodes. We have quite a few on there now. And cfbenchmarks.com is the place to go for the rest of our content. Aside from that, we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.